Good morning, everyone. Sanjit here from Opulent Invest. We're just going to wait for a few more attendees to join before we get cracking with today's webinar. So just bear with us and we will get back to you very soon. Right, we seem to have a lot more attendees now, so I think we're going to get started. Very good morning to you guys from a cold, wet and miserable London. Thank you very much for joining us for our first webinar of this year, entitled How to Profit from UK Property in 2024. There's people joining us today from all over the world, so a very warm welcome to you and thank you very much for taking the time out of your day to join us today. My name is Sanjit Danjal. I'm the Managing Director of the Opulent Group of Companies, and joining me today, giving me a hand here, is Ben Lane, one of our senior property consultants here at Opulent. I thought it would be useful to get Ben to join us today because Ben speaks with a lot of investors and can often give us a very good view of what our investors are thinking. So welcome, Ben.
Hi, everyone. And thank you very much for having me, Sanj.
You're very welcome, Ben. So a little bit about us before we get started. We're Opulent Invest. We're an award-winning UK property investment company. We've been around for 10 years now and trusted by over hundreds of investors and sold over £1 billion of UK property. We're highly rated on Trustpilot and Google reviews. That is us. In terms of an agenda today, we're going to try and keep it short and sweet, guys. Keep it to under an hour. That means I'm going to whiz through a lot of this stuff. So the first point we're going to cover off is we're going to look at the UK property market in 2024 and give you our predictions for what's likely to happen this year in the UK property market. Ben's then going to talk a little bit more about how to choose the right property investment locations and summarize our top 3 buy-to-let property hotspots of 2024. I'm going to then give you what we believe is the right winning property investment strategy for this year. I'm going to give you lots of tips and tools that you can use that will help you guys on your property investment journey. Finally, then, Ben's going to talk to us about the importance and the power of using an expert property management company. And then right at the end, guys, we will have a Q&A session, which will be your opportunity to ask us anything you feel you would like to ask us, anything you want to talk to us about the property investment industry or anything we're talking about today. Feel free to drop us a question. A few things to note just before we get started. I am going to be doing this at a very high level. Apologies if I'm insulting the intelligence of some of the experienced investors out there. And apologies if I'm going a little bit too advanced for some of the not so experienced investors. We're going to be opening up a Q&A, which I just said. So along the way, if there's anything you want to query us on anything I've said, just drop us a question in the chat and we'll do our very best to address those in the Q&A session. So let's get started with the webinar itself. The first thing I'm going to do is I'm a little bit curious, guys. I'm just going to ask you guys a question here. What did we think happened to UK property prices last year? If you could just answer that and let me know what your thoughts are on that just before I get started. I'm going to talk about 2024, but before I do so, I'm just going to summarize on what happened last year. And from what I can see, almost all of you have come up with they've either decreased or stayed the same. And quite frankly, I don't blame you for thinking that because that quite honestly has been the narrative from the mainstream media, from the government. I mean, last year was quite possibly one of the worst years for us as a company. The reason why is because there was a lot of scaremongering. There was a big problem with inflation, which I'll go and talk about in a second. But generally, there was a lot of uncertainty from our investors, which meant to far fewer sales. So it's interesting that we said that. But the next slide I'm going to show you is a true perception of what actually happened last year. And as you can see from this table here, this is the percentage change over the past 12 months. You will see from this that there were still many locations within the UK that actually grew last year, and even as high as 10%. So the point I'm trying to make here by showing you this slide, guys, is that whilst there is a lot of doom and gloom and negativity out there in the press, there are still pockets of growth in the UK for us investors to make money from, and to see good capital appreciation prospects, even despite all the house price indexes forecasting negative price growth this year for house prices. So that was the picture last year. It wasn't very good. Fast forward to this year, and certainly there seems to be a hell of a lot more optimism in the market. Is that something you've seen, Ben, from some of your investors?
Yes, absolutely. So I'll definitely say that a lot of people last year, especially with, Sanj touched upon a lot of the negative press, people were kind of waiting, seeing what was going to happen to the market. But I think a lot of people now have realised that the massive drop that some of the kind of news outlets were predicting didn't happen. Because when you actually look at the figures, house prices in England alone only went down by 1.8% over the course of the year. Now, when you remember back in 2022, people were predicting 10% falls, 15% falls. 1.8 is not actually that strong when you consider that, places like Scotland actually went up by 2.2%. It just goes to show that the outlook this year is a lot stronger, and there's a lot more optimism.
Yeah, and I think the UK economy once again has proven resilient in light of all of this turbulence that's been going on.
Absolutely.
And has definitely surprised a few people, that's for sure. So the first point I want to make here, guys, and we've probably touched on this a little bit already, is let's not always believe what we're being told by the media and by what's happening on TVs and things like that, because more often than not, these companies are doing their research. They're doing it on quite small data sets, which they're using then to generalize the entire property market. And let's face it, small data sets are not a true portrayal of what's going on in the entire market. So tread carefully with that stuff, guys. So do you want to say something about that?
Well, yeah, absolutely. So, there was one article that I saw that kind of particularly resonated with that. For example, there was a BBC article that said that from Halifax, prices were going to have dropped by 10% across the United Kingdom. Now, when you actually read the article and you actually look at the data set that they've used, what actually has happened is that the value of mortgages approved by Halifax was down 10% from the period last year. So that doesn't mean that the intrinsic value of the properties has dropped. It just means that with higher interest rates, people are buying cheaper properties, which I think makes sense.
Absolutely. So why are people more optimistic this year? And why does there seem to be a bit of a buzz around the market? Well, the first point I want to talk about in my predictions for 2024 is inflation. It seems to be something we can't get away from these days. Why was inflation running so high? What have the government done to counteract that? And more importantly, how's it affecting the buy-to-let property market? So look, inflation peaked at about 10.2% in October 2022. And the main reason it kind of got so high, I think, was, first of all, we had COVID and the procurement of goods becoming more and more trickier, which then meant those goods became more expensive. We came out of COVID and walked straight into the Russian invasion of Ukraine, which had a huge impact on energy prices as well as food prices. And then finally, what we began to see after COVID is a lot of the people who lived in Europe, mainland Europe, depart and go back home, which meant there was a shortage of skilled labour, within the UK, which
Yeah.
meant the cost of labour for so many companies just went up. And all those three things, I think, meant that inflation topped out at 10.2%. So what does the government do to counteract high inflation? Well, unfortunately for many of us, what they do is they increase interest rates. And that's a reoccurring theme of last year that we began to see. I think it was 15 consecutive rate rises on the spin. And what that meant was that the levels of disposable income for people dropped, and their spending curbed. And what we began to see then was a fall in inflation to where it sits today at 4.2%. And so seemingly it would appear that the Bank of England and the government, UK government here, have almost got it under control. And so what and that's kind of filtered through to the financial markets. They're a little bit more optimistic now, and they've even factored in 6 consecutive rate falls in order for the government to stimulate the economy again and avoid recession and GDP decline. And so now that the financial markets have seen it, what we're starting to see is the mortgage market and mortgage interest rates come down. I think the current buy-to-let rates are as low as 4%. Now, if you compare that to 6 months ago, where they were sitting at about 6%, it's a much more rosier picture. And so I think that's where the optimism is coming from, really. We predict that although some of the major house price indices like Halifax and Nationwide are quoting between 2 and 4% stagnation in property prices, we're actually saying that overall, as a market, as the UK, that prices are going to remain largely unchanged. We think the base rate will fall to about 3.25 to 3.5% over the next 18 months. We think the rental market will continue to be buoyant. We saw double-digit growth in many areas in terms of rental prices and the appreciation of rental prices last year. I think that won't be as high this year, but I still think rental prices will grow. So that there is our property predictions for 2024. The next section of the webinar, Ben's going to talk to us a little bit more about how to find the right location. Finding the right location is key to any investment. And so we wanted to spend a bit more time and share with you exactly what we as a company look for when we appraise our locations for our investors.
Yeah, absolutely. So kind of moving on to the kind of 4 pillars is what we call it, which is essentially what we look for in a good property investment area. So the first pillar is regeneration. Now, why is regeneration key to a good property investment area? Well, if there's regeneration, there's investment being brought into a local area, whether that be via private investment or through local government. So that means kind of new housing, new office space, new recreational areas, and also new infrastructure projects, things like HS2 and Crossrail, for example. Now, as this regeneration comes into an area and the investment comes in, that in turn attracts more people to the area, which means there's high demand for housing. That puts up pressure on house prices, which kind of falls nicely into the next topic, which would be population growth. Because very simply, property is just like any other product. It's a supply and demand aspect. So if there is a growing population in an area and the supply of housing does not keep up with that demand, then house prices will naturally rise. And that's the same for rental prices as well. And that's why last year, rental prices rose across the United Kingdom, just very generally, is because there was a high demand for rental. Now,
just on that note, Ben, when you talk about population, you're right. It's a great point.
Yeah.
But what sort of level of growth in population do investors need to look for it to become a compelling opportunity for them?
Yeah, exactly. So you're looking at kind of growth between 5 to 7% over a 10-year period. Now, the way that you find these figures is basically by, you can simply Google them for a certain city or location. But for the more minutiae data, you can look at the Office for National Statistics and basically look at census data, because essentially you want to buy in areas where the population has grown and is predicted to grow moving forward. And local government websites is where you can find a lot of this information on. So then moving on from population growth, it kind of again comes hand in hand with the strength of the local economy. You want to be buying in an area where there's a lot of good jobs, so you need to look at the kind of local employers that are in the area, what kind of employment that is, what the new business generation rate is in that area, and also what the unemployment rate is, because you want to be attracting the kind of tenants that can, first of all, afford reasonable, rate rises over the course of 5 to 10 years, and also are going to be the kind of tenants that aren't going to potentially create hassle for you, and will be able to pay the rent on time. So that's why looking at the strength of the local economy is absolutely important. And then finally, education establishments. So the first very obvious reason why is that if you buy in an area that has a lot of universities, for example, there's going to be a lot of students, and students are of the age where they're going to be renting a lot. So you're going to have a lot of rental demand. But then also by attracting a lot of students to an area, that will then have a knock-on effect on the population growth, because if there's a high graduate retention rate, then it means that puts a natural effect on the local population growth. And then when it comes to education at a lower level, like schools and that kind of thing, again, if there are good schools in an area, that will attract families, again putting upward pressure on house prices.
Just to talk once more about population growth, Ben, because you made a very valid point earlier in that when there's a lot more population and less supply, property prices will increase.
Yeah.
I think it's worthwhile mentioning here, and I probably should have done this on my first slide, but this supply gap as a nation for the UK as a whole is just widening, isn't it?
Yes, it is. So actually, since the 1970s, so since the Labour governments of the 70s, we've actually had a shortfall of house building within the United Kingdom, and that has been, we've been targeted at about 300,000 properties per year. So as you can see, even from 2000, there has been a massive shortfall of that. But this sort of supply gap goes all the way back to the 1970s. So we've literally had 50 years of us not building enough houses in this country, and that's what generally drives up the
house prices.
The house price,
exactly right. That. And guys, if there was one point I'd like to make, perhaps more significant than all the others, as to why house prices in the UK will always go up over any given period of time, and that is because we as a country simply aren't building enough houses. We've got a general election coming up later on this year. We're going to hear all the narrative, and we're going to see all the manifestos about, both parties, stepping up their house building. But time after time after time, we're getting let down. And the government are not building enough properties. And this isn't something, as Ben mentioned, that's just happened over the last 3 years. I mean, this has happened consecutively over 30, 40 years. It's a real problem, and will mean that even after things like the global financial crisis in 2007, 2008, prices fell off the face of a cliff, but then very shortly after they recovered, and then they recovered to pre-global financial crisis levels. And the reason why they did that, in our opinion, is because the government are simply not building enough properties in this country.
Absolutely, and you'd be very hard pressed to find a property that was purchased in 2006 that isn't worth nearly double. Now you'd be very hard pressed anywhere within the United Kingdom.
Exactly, I agree.
So moving on to the commuter belt effect. So the commuter belt, we basically define as an area around a very large urban conurbation, where essentially people live and work, but also predominantly travel into the larger kind of city for their work and also for leisure. So we're looking at the reasons why people move out to the commuter belts, because a lot of the major cities, as you can see from Sanjit's first slide on where prices rose a lot last year. A lot of the major cities are stagnating as prices have risen to a very, very high level, and basically it has become unaffordable for a lot of people. So what they're deciding to do is moving out to areas which are within easy access of those large cities, and have good amenities themselves, more outdoor space, but they have everything that they need on their doorstep within the larger city next door. And so you can see here, a number of the other reasons why. So it's more family friendly. From an investment point of view, you've got good rental growth, price appreciation prospects. And just lastly there, the Crossrail effect. So large infrastructure projects like Crossrail are designed specifically to help commuter belt areas gain more accessibility into the major, conurbation areas. So moving on to the next slide. So the top 3 hotspots that we're going to look at is, first of all, the commuter belt around London. Second of all, is Birmingham actually itself, and also the areas surrounding Birmingham. And then finally, Southampton. As we have identified these 3 areas as ones that are going to be good for investment in 2024. So first of all, the London commuter belt. So London itself, prices are very, very high. You don't need me to tell you this, but London itself, prices have risen at a staggering rate, and it has now become very unaffordable for a lot of people to actually live and work within London. So first of all, when you look at the figures below, on price growth between 2010 to 2022, you can see that actually growth within the home counties, which is the counties that are literally circle around London, the price growth there has way outstripped the growth that you can see in London itself. So Buckinghamshire at 70%. Again, reasons for why Buckinghamshire has grown so quickly. You've got grammar schools, so you've got good education links there, and also you've got the Chiltern line, so you're looking at good transport links. Surrey, Berkshire as well have, again, good schooling, good transport links into London, so that's why they've outstripped them. Now, having had a look at the optimism for this year as well, so within the home counties, in the first 2 weeks of this year, Rightmove saw an increase of 19% in inquiries compared to the first 2 weeks of the year before. Again, showing that there's not only optimism within the market, but where are people looking to buy, and they're looking specifically in the home counties area. Furthermore, we're talking about population growth being important. In the home counties, there was 9.5% growth between the last 2 censuses, again outstripping the national average. And then when you look at the effects of the infrastructure projects, Crossrail, so along the line, since it was announced, prices have increased by 215% on average for the areas that are along Crossrail. And then again, analysing about how last year, whilst it wasn't the best property market, but wasn't actually as bad as it was made out to be. So 10 out of the 13 district councils northwest of London, so you're looking at Buckinghamshire, Hertfordshire, Berkshire, 10 out of the 13 district councils actually saw price increases rather than decreases last year, which is actually quite surprising, especially when you consider that these areas often have very expensive houses that need very large mortgages on. So it just goes to prove the resiliency of buying in a commuter belt area near, one of the world's great cities.
Yeah. I think it's spot on there, Ben. And also just to add to that, or question you actually on that.
Yep.
How significant do you think the change in kind of government policy around things like HS2 not going up to Manchester now, and seemingly kind of pulling away from this whole kind of northern powerhouse and initiative to create a more balanced economy? How much do you think that's kind of playing into that?
So I think with HS2, I mean, especially for the north, I do think the Midlands will definitely benefit from HS2, but I think it's a very clear indication from the current Conservative government, especially. And when you look at Labour, they're not particularly keen on HS2 either. But it just shows that they actually aren't as serious about investing these big, large infrastructure projects in the north as they are in keeping, kind of wealth within the south. So it means that, again, there's going to be more job opportunities and kind of more investments within the areas in and around London, which again makes the commuter belt a very attractive prospect.
Indeed. I mean, certainly, over the past kind of 12 months or so, we've seen an increase in the number of inquiries we're getting from our kind of London and southeast properties. There was a period of time there for 4 or 5 years where everyone kept inquiring about Manchester, Liverpool.
Yeah, exactly, up north.
And I'm not saying these places aren't a great place to invest. I'll talk a bit more about that afterwards. But certainly what we're seeing now is more and more people coming back to London. And actually, if you look at some of the prices, on the outskirts, even in Zone 5 or Zone 6, you can often pick up one-bedroom apartments cheaper, if not the same price, as a one-bedroom apartment in Manchester.
In central Manchester, exactly.
Such as the price has grown in those regions. London's definitely on the up.
Perfect. So kind of moving on to the next area is we're going to be looking at Birmingham and the commuter belt around the Birmingham area. So Birmingham is the UK's second largest city with, I think from memory, about 2.4 million people and with the second largest economy within the United Kingdom. So over the past 5 years, Birmingham and the surrounding areas have increased by 19.2%, again showing that there's going to be a massive increase, in house prices, and that is going to be seen moving forward as well, especially when you consider that Birmingham is actually one of the youngest cities within Europe. So when you look at population growth and demographics again, this means that the number of people who are going to be coming into the market, who are going to be looking to rent, but also looking to buy over the next 10 to 15 years is going to be a lot larger compared to other cities. And that's not including, kind of organic growth from people moving to the area. For example, students. So Birmingham has the second largest student population outside of London, just after Manchester, with 80,000 students kind of housed across 5 universities. I myself actually went to university in Birmingham, and I know that it is a fantastic university city. And I was very close myself to settling in Birmingham. But the graduate retention rate for Birmingham, I think, again, is in the top 3 locations within the country, because there is a fantastic, fantastic employment there, good job growth, and also a fantastic nightlife. So when you look again at what's causing the price growth and what's going to help it moving forward, you're going to look at shortfall of houses. So 78,145 shortfall of houses between 2020 and 2042, which is massive. When you consider that the population of the Birmingham Authority itself is only 1.1 million, that is absolutely massive. And obviously within the wider area, it's about 2.4, but still that is a very, very stark very stark figure. And then when you also consider that HS2, whilst it is being cancelled from Birmingham northwards, actually that could work in Birmingham's favour, because if it means that Manchester won't be as connected, Birmingham will be kind of like the gateway to London, so to speak. So that will actually attract more businesses to locate into Birmingham, where they can easily access London. And especially areas like the Birmingham Business Park, where you've got the Birmingham International Railway Station, that will also take people on HS2 directly to London. Again, that's very accessible by areas just outside Birmingham, so it'll attract people not only into the city itself, but also into the wider countryside and towns and cities that surround Birmingham. And then moving on to our final location that we feel is a little bit of a hidden gem and hasn't really been talked about a lot over the past kind of 15 years, is Southampton. So why Southampton? Well, I mean, it's from memory, I think the 11th largest city within the United Kingdom. It's also part of a larger urban area, because you've obviously got Portsmouth on your doorstep as well. So you've got 7% average yield at the moment, which is actually one of the highest in the south of England. Normally for yields of that level, you do have to go to the north of England. So seeing that in the south is actually very unusual. And also a population growth of 8% by 2024. So 8%, as I was mentioning to Sanj, you're looking for 5 to 7% over a 10-year period. So 8% in a 5-year period is absolutely massive. And that, again, will put massive upward pressure on house prices. Because whilst you do have large regeneration projects that will be able to cater for some of this demand, like the Bargate Quarter, like the Chapel Riverside, like Centenary Quarter, it won't be enough to completely be able to service it. So again, Southampton is in line for some very good appreciation and also rental increases as well. Because over the past year alone, whilst the average rent increase across the UK was something like 5 to 6%, in Southampton alone, it was close to 10%, which is one of the sharpest rises you will see anywhere within the United Kingdom. And again, looking to kind of other factors that drive price growth. So Southampton itself is a university city. So you've got 34,000 students across the University of Southampton and Southampton Solent as well. Again, the graduate retention rate in Southampton is very, very high. And Southampton University is one of the world's most renowned university establishments. So Tim Berners-Lee, who essentially invented the technology that has enabled the internet, he is a senior lecturer at Southampton University. So it's one of the top institutions within the United Kingdom.
Thank you for that, Ben. Always useful to understand more about what locations are doing well in the UK. I think you touched on some really good points there. So thanks very much. Look, just before I get on to section 3, guys, I just wanted to let you guys know how overwhelmed we are by how many people have attended today. We're into the 200s, which is very, very good. Thank you also so much for your wonderful questions, which we'll try and get to at the Q&A session. But yeah, look, let us know how we're doing. If there's anything you want us to try and pick up in the Q&A section, I'm going to ask you guys another question here, which is all useful for us. So you'll see that pop up on the right-hand side of your screen. Just let us know which best applies to you. And now I'm going to move on to section 3. Which is identifying the winning property investment strategies for 2024. Now, I think we've touched on this a few times. Ben's talked about it through within the commuter belt region and also recently just now. But essentially, this rests at the core of everything we do here at Opulent. We're all about identifying those emerging markets, those emerging areas that haven't hit mainstream investors yet. They don't know about it. Where all of those fabulous things that you talked about, Ben, regeneration, population growth, education establishments, and strength of local economy are all present. So buy in those areas, but buy when prices are low, because no one else has found out about this hidden gem, as it were. And then when all of that regeneration, all of that population growth and all of that occurs, and when all of the mainstream investors then find out about the location, that's really the time you want to look to sell. And this is my point that I made earlier about kind of Manchester, Liverpool and Sheffield, all of these kind of buzz areas that everyone seems to want to invest in. Now, these areas will do well. It's fine. You'll still make conservatively, 3 to 5% per annum on growth. And if that's enough for you, then great. But there are other areas within the UK that are perhaps less known. If you rewind back to the first graph that I showed, where I showed the top 20 or 30 growth locations last year, I would say maybe 3 or 4 of those areas stood out as obvious locations for property investment. So buy low, sell high, and try not to follow the mainstream investors if you're serious about making growth up to 10% per annum from UK property investment. That really is the key here, guys. It's what we tell all of our investors here at Opulent. To make the most and to profit the most from UK property, you really need to find those hidden gems. So once you've done that, alongside that, even another point to consider here, guys, is that within property there are various different asset classes that all offer different things to investors. And what this comes down to, guys, and it's something we do, or I like to think we do very well here at Opulent, it's all about understanding exactly what it is you want to achieve. Do you want to secure long-term financial security? Are you looking to create more additional income because some of your mortgages have increased with the interest rate rises? Are you looking to fund your retirement and create a passive income to fund your retirement? All of these things require a lot of thought, guys, because depending on what you want to achieve, there are asset classes that will help you get to that point a lot quicker than others. For example, if you're not too interested in income, more in it for the long game, and interested in capital appreciation, then look at a residential buy-to-let, straightforward buy-to-let property that will give you, 5 to 10% growth per annum, depending on where it is over a consistent period of time. If it's income you're interested in, not so much capital appreciation, because maybe, as I said before, some of your mortgages have gone up, or, you're having to subsidize those mortgages personally, then, look at perhaps student accommodation, where you can buy these units, often sort of 50, 60K per unit, but will offer typically much higher yields than residential buy-to-let. You're looking at around the 7 to 9% mark, whereas with buy-to-let, the average yield is around about the 5.5% mark. If you want income, another strategy to consider, which a lot of people are talking about these days, is short-term lets. Now, short-term lets, I'll spend a little bit of time talking about these because everyone seems to be offering them these days. And don't get me wrong, when you do it right, and use the expertise of a specialist short-term let management company, then there is more money to be made than on a long-term let.
Absolutely.
There's no doubt about that. In some instances, you could almost double your long-term let by operating it as an Airbnb style serviced accommodation apartment. However, there are kind of concerns that we're hearing from some of our clients in terms of wear and tear, in terms of damages, in terms of Airbnb parties. So this is why I say it's extremely important to use a specialist management company when it comes to short-term lets. I wouldn't bother trying to do it yourself, and they have to be experienced. What are your thoughts on that, Ben? Is this something you're hearing a lot more from your clients?
Yeah, absolutely, because I think just very generally with property, when prices rise in an area, rents don't keep up at the same rate, which is why in more expensive areas you do get these lower yields. So a way to kind of counteract that is people are kind of turning to short-term lets. And the thing is with short-term lets is that, yes, obviously once they are run well, once they're established, they do offer a much higher return on investment. But as ever with most investment, the higher the return, the higher the risk, because obviously with short-term lets, you are responsible for all the costs, which will be much higher compared to a long-term let. Because a long-term let, you basically get the tenant in, they pay their council tax, they pay their rent, they pay their council tax, they pay all the bills, so on and so forth. But when you are doing short-term lets, you have to take on the obligations of all of those bills, plus also higher management fees, because obviously management companies will charge more if they're having to turn over people every 2 to 3 days compared to dealing with one tenant over the course of 2 to 3 years. So there's all of that to consider. And the thing is, once done well, short-term lets work well. But another thing that I've seen as well is that actually sometimes the more obvious locations for short-term lets might not necessarily be the best. Because, I remember I was at a wedding last year and actually spoke to someone from one of the companies that we recommend called My Property Host. And he said that actually short-term lets they were finding in Manchester were getting lower occupancy rates because there is just so much competition. So whilst Manchester is obviously an obvious choice for doing short-term lets because you've got lots of different businesses, lots of tourism, and so on and so forth. Because the competition from other people doing the same thing is actually very high, it actually affects the occupancy. Whereas, for example, one area that they operated in was Ashford in Kent, where we had a property that we were selling there, and actually the occupancy levels there were much higher. So,
thanks for that, Ben. Yeah, all very valid points again. So guys, just to summarise, really have a good think about this. You know, this isn't something that's going to be decided in a day or two. You really need to understand exactly where you would like to get to, and then plan how you're going to get there by buying the right property asset class. The third point, and this is perhaps probably the question we get asked most here at Opulent from our investors, and that is, do I buy through an individual name, i.e. yourself, or do you put it through a company? Now, for us, there is no debate here, guys. If possible, and wherever possible, you should be buying your properties through a limited company. Now, I know for some investors that's quite daunting, it's quite scary. There's often this kind of conception about buying through a property company or being the owner of a company, that there's all these kind of administrative tasks and, you know, tax returns and, you know, this return, accounts, all of that. You know, and you know, for someone who kind of isn't in the industry, that can seem quite daunting. But let me tell you the benefits about buying through a property, through a company, to buy your property. And the first thing is tax. Now we're not tax specialists. We're not qualified to give tax advice, but it's quite obvious to see that if you buy through a company, you're subject to corporation tax as opposed to income tax. Now, a lot of our investors are often high income tax payers. They're often earning, you know, over £50,000 a year. So then any additional income they earn is taxed at that same rate. You know, why put yourself through that, guys? You know, quite simply, if you buy through a company, the company is taxed on the profit. And corporation tax at the minute is, you know, 24%. It can be a lot lower than 50% if you're a high income tax earner. There's also inheritance tax advantages in the sense that it's a lot easier to change the director of your company as opposed to selling that property or gifting that property to your child, which will incur stamp duty and things like that. And also with buying through a company, you can also shield your personal assets as opposed to buying through your own name. Let's just say, you know, you're not able to meet your mortgage payments, etc. as an individual. There could be recourse there to come after you personally. By buying through a company, your liability is limited. There are things like costs to consider. You will need to do accounts and things like that. But actually, when you unravel all of that, there are companies out there at the minute, some of which I use personally, that will set the company up, set your bank account up. They'll do all your tax returns. They'll do all of your company accounts, and they charge from as little as £20 to £25 a month. So consider doing that, guys. If you know that's a very valuable point. In terms of taxation.
Yeah, exactly. Because also a couple of the other benefits as well of buying through a limited company. So if you are buying a property through the company, you can basically give that money from your personal account to the business account. And then you can basically take the rental payments that you get from the business as a loan repayment to yourself, and loan repayments aren't taxed. So essentially you can get tax-free income. Then furthermore, when it comes to selling on the property, you can sell that property on to the next purchaser. You can sell it through the business. And essentially that person won't actually have to pay stamp duty because they're buying a business and not buying a property. So again, that means you can sell that property for more profit.
It's essentially what we call a share purchase acquisition. You're quite right. And I suppose it's worth talking here now that you can only really do that on a property if you have one company set up for each
company.
If you've got one company for multiple properties, then it's going to be that benefit.
Well, you have to sell the whole portfolio.
But you know, the advice that we would give is to set up a company for each property. And as Ben quite rightly mentioned, the time it comes to sell that property, the new purchaser of that property would be purchasing your company that subsequently owns the property, i.e. taking over the shares of that company. And the tax for that, I believe, is 0.5%, which is a downside lower than the stamp duty rates. So guys, once again, no question here for us. If you're thinking of buying an investment property, consider buying through a limited company. Next point is plan your taxes. Again, this is a place where a lot of our investors get unstuck. They don't necessarily consider all of this before they're buying their property investment their properties, and it's something that they usually get to afterwards, i.e. reactive rather than proactive. You guys should really be proactive about tax and good quality tax advice. Particularly here, we're talking about, if you're looking at buying a substantial portfolio, really you should be talking to a qualified tax expert who can help minimize your tax liability moving forward. It doesn't come cheap, but I would advise clients, if you're considering building a portfolio, to definitely seek the advice of a good tax consultant. This is a tricky one here. Consider off-plan to hedge against interest rates. I thought I'd put it in there because one of the biggest reasons why people aren't investing at the moment is because interest rates are so high. However, another reason why people aren't investing at the moment is because construction costs have gone through the roof. And a lot of these off-plan projects are being stalled. In some instances, developers are having to write to clients and ask for more money simply to finish the projects off. So I give you this point cautiously, and really this point only applies to working with good quality, credible developers who are fully funded and who have a track record of delivering off-plan projects. Because at this point it can be risky. However, it is a great way to counteract the high interest rates at the moment, because from speaking to all of the brokers we deal with, the general consensus is that mortgage rates are going to come down over the next 12 to 18 months. And so a great way to offset the risk, is by buying an off-plan property, investing today on something that completes 12 to 18 months down the line. You only need the mortgage when the property completes, and so the likelihood is interest rates will be lower at that point. So that's another potential strategy that people can use, but do so cautiously and make sure you're working with the right developer. Always do your research. It seems quite an obvious one, this, but there seems to be, by a lot of investors, especially the amateur ones, that the profiting from the UK property market is easy. Because we've heard all the stories of people doubling, tripling the values of their property, almost by accident in many cases. There seems to be this misconception that it's easy to make money in property. And I can tell you, for one, having gone through all of that, it's not easy. And the only way to kind of mitigate any risk is by doing your research. And when I say do your research, I mean, meticulously do your research. Look at what's going on in the area. Look at what's going on in the immediate vicinity of your project, the project you're purchasing. And look at the credibilities of the developer. Look at the credibilities of the management company. Look at, unemployment rates in the area. There's no limit to what we can find in the public domain. You just need to get out there and look. But it's not easy, guys. So tread carefully, or partner up with a company like ourselves who do all of this for you.
Exactly, and on that note, I think it's very easy to get drawn into kind of adverts from companies that are offering, very high yields of, kind of 10, 12, 15% per annum. So when you do see those opportunities, do tread carefully and make sure you do your research, because quite often those are the ones where they sucker people in with high returns, but then don't actually deliver. So just make sure that you do your research and look at the validity of those properties.
Thank you, Ben. Last point on here, which Ben's going to talk to you a little bit more about afterwards, but I've put here use a specialist management company because recently it seems more so than perhaps times gone by, we're getting a lot of investors who want to manage their properties themselves, and quite often they're coming unstuck. These are often people who are busy, have got, jobs of their own 9 to 5, but, in order to save, 7, 8, 10% of their gross monthly income, they are managing the property themselves. And with that comes a whole heap of issues, really, especially for those who are time-starved. You're going to get all sorts of calls from your tenants, complaining about this, complaining about that. And the question to you is, do you really need that in your busy days? But also, specialist management companies, they know what they're doing, especially if you're working with the right one. They'll find you good quality tenants. They'll find you tenants fast. They'll minimize your void periods. They'll reference all those tenants. And Ben's going to talk to you a lot more about this. So I'm going to hand it over to him. But those guys are what I would say are the things you need to be looking out for this year if you're wanting to make money from the property market here in the UK in 2024.
Yeah, absolutely. So as Sanjit touched upon, the power of an expert property management company. So the big one is, how valuable is your time? Do you want to be dealing with the small kind of issues that tenants have with the properties, calling out plumbers late at night if there's a leak, kind of dealing with them maybe not paying rent for, sort of like a few days and having to chase them. All of this can be done and solved by employing a proper management company who can solve all of these issues for you. And one of the main things that they can do is ensure good quality tenants as well on the property. Because if you get good tenants in that pay the rents on time and to the right level, you're not going to have any issues. And they'll be the ones that actually keep the property well. So it means that when it comes to reletting, you're not going to have much work to do. And also knowing the legal landscape and what is required. It's not as simple as it seems when it comes to property management. I remember the story of one of our investors who bought a property previously and decided to manage it themselves. And they had a tenant in there, and they decided to manage it themselves. So they took the deposit from that tenant and basically just kept it in their bank account. Now, when it came to that tenant leaving, the tenant actually trashed the property. So there was thousands of pounds worth of damage done. However, our investor could not actually claim back that deposit money, because the deposit money, they did not put that in a protected account that was backed up. So it actually meant that investor basically lost that tenant's deposit and just had to basically pay for all of the works themselves. So that's why getting someone who knows the legal framework and has everything sorted in that respect is absolutely key, because you avoid these issues.
I just think on that note as well, with compliance always changing, I can't stress that point enough, really. You've got EPC laws changing, you've got electricity and gas certificates, new legislation.
Yeah, tenants' rights, those kind of things. Yeah.
There's a lot going on. So yeah. Very important to use the right management company.
And moving on to that as well, not just using any property management company, you've got to use the right one. Because again, a headache I have from a lot of my investors who come to us is they have various properties where they're using managing agents that are charging them 5 to 6% of the rental income. And generally in life, you get what you pay for. And when you pay for a cheap management company, they're not going to do checks on tenants. They're not going to be updating you and chasing for rents. They're not going to be fixing issues quickly. So that's why choosing the right management company is absolutely key. And that comes on to our kind of final points, which is the total property investment solution from Opulence.
Now, we kind of cottoned on to this, guys, and we were hearing from our investors all the time that most of the property agents here in the UK will be quick to help you once you've exchanged and completed. The service levels tend to drop, and they've had their commission, and they seem a little bit less interested in helping you out with things like furniture, things like management companies, letting companies, things like finding good tenants and stuff like that. It kind of drops off. And what we saw was a bit of a gap appearing in that a lot of our investors, were coming to us saying, look, we bought this property through another company. It's completed, but what happens next? And that kind of inspired us to create what's on your screen here called the Total Property Investment Solution. And in a nutshell, what this is, guys, is the power of simplicity. And by that, what we mean is, regardless of whatever stage you're at with your property investment journey, we as Opulent can provide you with a single point of contact. So one person to discuss all your property affairs, whether that be to research the property. If you want to speak to one of our consultants here, they're very well rehearsed on all of the key areas within the UK, and they know what they're talking about, and they're backed by lots of research that we've done. So we can help you identify the right property for you, the right area. We can then go ahead and sell you that property, because we work with developers up and down the country who rely on us to sell their developments. But once you've bought that property, this is where usually things kind of go a little astray. And so you will have that same point of contact that you did the research with and you bought the property through, to then help you with the management. We have our own management and lettings team, where we manage most of our investors' properties through that. We then basically will provide them with, monthly statements, how long their property's been void, empty for, etc., how much income they've generated. But let's face it, every investment, it doesn't last forever. There's always going to be times when you want to exit that investment. And so, look, the same point of contact will still be there. Even, hopefully, if he hasn't left the company, 2 or 3 years later, you could give maybe Ben a call and say, look, Ben, thank you. We've bought the property. We've done okay. I need to exit the investment now. What do I do? Well, once again, Opulent can step in there and help you resell that property. We'll relist it. We'll sell it to another one of our investors, and then that will give you the funds to effectively go again or do what you want. This seems to be working very well for our investors. And if you're someone who's time starved and don't necessarily want to inject too much time into property investment, but rather create a passive income, then the solution is for you. So that pretty much is it from us, guys. We're going to get to your questions, but just before we do that, I'm just going to talk to you a little bit more about how Opulent can help. As I mentioned before, we're award-winning. We've been around for a number of years, and we're talking to clients from all over the world, help gain a foothold in the UK property market and profit from the UK property market. We're award-winning, and we've got lots of positive reviews. And here's a few of our current opportunities, guys. Just to breeze you through it, it's not a sales pitch. I'm not going to spend ages on this, but these are a few of our opportunities. And again, in keeping with the buy low, sell high theory, here's Stafford. It's Birmingham commuter belt. It's not on the tip of everyone's tongue. It's basically property prices starting from 98,500. There's a 10% net return on short-term lets, but more importantly, it's completed, it's tenanted. And prices here are very good. It's genuinely at 10% below market value. So that's one of them. We're also doing stuff in and around London. This is a project in Staines, just outside Heathrow Airport, in fact 10 minutes from Heathrow Airport. Price is from £255,000. That's a one-bedroom apartment, guys. So again, 1 bedroom in central Manchester, you're probably looking at 275, 280. So this is effectively London, Heathrow Airport, 40 minutes from the centre of London by train, and very close to Heathrow Airport. And if residential property is not for you and you want income, then we're also very active in the student accommodation space, where you can pick up small, compact student properties with a desk, a bed, an ensuite, for as little as £50,000. The yields are quite good at 7 to 9%. These are completed operational, no development risk, but they are cash purchases. So that's it, guys. Thank you ever so much for that. We've inundated with questions, and so we're gonna get to a few of your questions now. And this is the one that's staring me in my face, Ben. And I know it's one we've got our own thoughts on. But the question from one of the attendees is: do you think social housing investment is worth it?
I was going to say that was the question I was also looking at as well. So yes, so there's a lot of hype around social housing at the moment, and rightly so. They're offering yields of sort of 10% net. You're buying a freehold house as well, so you're not buying within a block. So you supposedly have full control and that kind of thing. And whilst the principle of it is it is very good. It's obviously supposedly government backed, 25-year leases, and that kind of thing. But when you actually dig down into it, it's not government backed. Essentially, what they are doing is they're renting these houses out to local housing providers, which are kind of quasi-private and government companies. And basically, the contract isn't for 25 years. They kind of renew every 3 to 4 years or so. And also, how can you guarantee a rent for 25 years and know exactly how long that rent is going to be guaranteed for? Because the issue is, me and Sanjay have spoken about this a lot because we've thought about taking on social housing, but we've decided that we feel it's not the best, not the best thing to do. And the reason why is what happens if there's a change in government? Because if a Labour government comes in, are they going to look kindly on investors profiting 10 to 12% per annum off the taxpayer for housing, kind of people who need housing or assisted living schemes? Is that the kind of thing that they would want to do? And the issue is that we feel that there is a time limit to how long these investments will last. Whereas traditionally, they were sold by pension funds. And I'm sure a lot of the companies are saying that these kind of things were sold to pension funds. That's correct, but pension funds need returns of 5 to 6%, which is much, much lower. And again, to get these properties, especially for the assisted living, to get them suitable for assisted living, they have to be retrofitted. So quite often, these properties are being sold at 30 to 40% above their actual market value, and then basically are being subsidised the rent because they're actually getting paid 7% by the local housing association, and the rents are being topped up by the difference in the price.
Exactly that, and I think that's the key for me. In a nutshell, what you're doing is buying a property that's grossly overvalued, and the way they're being able to sell it to you is because there's no finance involved, no bank valuations. It's a straightforward purchase, and whether that makes good investment sense in itself, i.e. tying up all your funds rather than buying multiple properties through leveraging, is questionable as it is. But I've done a lot of research into this industry, like we research many industries when considering them, and actually what it came down to for me is that there's a question about ethics here on behalf of these housing providers who are essentially letting investors capitalize from the UK taxpayer who are paying for a lot of these.
Yeah, absolutely.
And so that's quite kind of doesn't sit right with me. Also, anything that looks too good to be true, guys, what's coming next. It usually is. And a 25-year government-backed guarantee, I find that hard to believe, especially seeing as though governments change every 4 to 8 years. It's difficult to see that working. So I know this is everywhere at the minute, and it makes our life quite tricky as well, because we're pushing genuine buy-to-let deals that are offering 7 or 8%, but everyone wants 10% now. Yep. And it makes life difficult. But yeah, tread carefully with that, guys.
So there's another question from Janaya. Is there a lot of red tape for investors who are not UK residents?
Yeah, great question again, and it's a question we get asked a lot. In a nutshell, it's the same process as it is for a UK investor than it is for an overseas investor. You don't need to come here to the UK. Everything can be done remotely, and in the same way we would introduce you to solicitors and things like that over here, a UK investor, we would do exactly the same with yourself. And rest assured, if you were to invest through Opulent, we've got a very well-staffed sales progression team who are on hand from the point of reservation to guide you through and hold your hand through every step of the legal process thereafter.
Okay, perfect.
Let's go through some of these other questions.
So there's one from John Edmonds about student accommodation. Imagine high damage to fixtures and fittings. How would replacements be funded? So that's a very good question, because obviously when you do rent out to students, inevitably students, they like to have a good time. They do cause damage to the property. So how are you protected against that, especially with student accommodation as your as it's a cash investment, you get the high returns, but that's on the cash amount, so you're not leveraging as well. So the way that that's protected is essentially every student not only has to pay a deposit, but also has to have a guarantor that essentially guarantees their rent and also any damages that they cause. So even if they are an international investor, with all of the properties that we sell, that particular tenant, even if they're an international investor, has to get a company in the UK that guarantees their rent and also any damages. So essentially, the way we do it is by having a established management company who basically ensure that everything is covered, and the students aren't able to damage the property and get away with it, essentially. So there is coverage there.
All right, we're gonna cap it off there. Sorry, the webinar overran slightly, so I can't get back to all of your questions straight away, but I will reply to all of them individually. Rest assured of that. And also, guys, there's a little thing that should have popped up here to book a 15 or a 20-minute slot with us here. Like I said, impartial. One of our consultants are available to speak to, get some advice from. Understand exactly what you're looking to achieve, and then perhaps look at suggesting property investments. So if you'd like to book one of those appointments with us, just click the book now button on your right hand side, and we'll arrange a time and a day to speak with you. But outside of that, guys, it's been wonderful hosting today's webinar. I really hope you found it useful. It's impossible to cover off what everyone wants to cover off on these types of things. But look, if there's anything you want to ask me specifically, or you've got something on your chest that you need to speak to us about, please give us a call, book a consultation, give the office a call. The number's there on your screen, and we'll be more than happy to speak to you. And keep a lookout for our next webinar, which will be coming up next month, which we hope to see you at. So thanks very much, guys. Have a lovely day, and we look forward to seeing you next time.
Cheers. Thank you very much.